This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview. Well, hello and welcome to the Research Talks here from Stockbox, coming out on a Monday, a little bit later than planned. But Alan, you've been on holiday, that is why, of course, and maybe you have indeed brought the sunshine back, because certainly it's been finally some nice, warm, hot weather for us in the Netherlands. But how was your holiday? How's it all been?
Hello, Mark. Thank you for the welcome back. Yes, I had a terrific time. We rode, four of us rode across to Germany and had fun spinning around central Germany, in particular the Eifel, which is a wonderful place. Of course, the Nürburgring is there, and yeah, we had a great time. But actually, the weather when we were there wasn't particularly good.
Okay.
We had 3 good days, and we endured some fairly heavy rain on the other days. But yeah, it was still good fun nonetheless. And of course, Germany's in the middle of the Euros at the moment, and we sat in a pub in a town called Bad Wildungen and sat with all the German fans when they had their amazing win on Wednesday night. And yeah, it was a great time, really good time. And
Good.
yeah, I think the sunshine's arrived of its own volition rather than me bringing it.
Well, anyway, it's nice to have it, isn't it? It's definitely nice to have it here, so that's good. Well,
Yeah.
Thank you for your time again on the Monday. Today we're talking about companies that two that we've never spoken about before. The first one is Helix Exploration. So I'm looking forward to hearing about this company. Then Brave Bison, who we have spoken about before, but you're going to give us a bit of an update on them. And a new company, Manolete Partners, hashtag there, Mano. Or Manolete, I'm not sure how you say it. Manolete Partners, is it?
Manolete, yeah.
Manolete Partners,
yeah.
Manolete Partners, yeah. Okay. So is it Helix first, Alan?
Yeah, let's start with Helix, Mark. This is a really exciting helium play, and I think it's what I like about Helix is the company, of course, IPO'd in April this year, came to market and raised at that point $7.5 million to fund helium exploration and development in Montana in the northern USA, and of course. It's well established that there is a scarcity of helium around the world, and helium is selling from anything from $650 dollars per million cubic feet up to $1,000 per million cubic feet. All of the numbers that you're going to hear today are quoted on a more conservative $550 per million cubic feet. So it's important to set that into context. So why Montana? Well, this has a lot to do with the management. So Bo Sears, of course, is chief executive. He's had 25 years operating within the helium industry. He discovered the Manolete project in Canada, which now produces grade A helium. He's even written a book, or he wrote a book in 2015 called Helium, the Disappearing Element. And he's become very much an industry reference point and authority on helium. So along with the chairman, David Minchin, he set up and bought Helix to market. David, incidentally, has 20 years of experience as a geologist and also in corporate finance. Also was the former Helium One chief executive and has worked in a fund manager raising funds for similar projects. Then we have Ryan Neitz, who's chief finance officer, and Keith Spickelmeyer and Greg Peters, both non-exec directors on the board. So Bo Sears has been long operating in this region. So we're looking at the Montana, what's referred to as the Montana Helium Fairway, which is a huge area, of course, that extends from Saskatchewan in Canada to Wyoming in Central America. And this is this area is host to helium production from North American Helium and the Vail Group. What the company have secured as they IPO'd, 52 leases over what is referred to as the Ingo dome project, which has characteristics of what is referred to as potentially massive flathead style helium discovery. The company and the geologists working in the area previously have identified gas, nitrogen, a high percentage of nitrogen, which is indicative of helium. The geology in the area is a thick sediment and referred to as a large trap. Some 16,500 acres have been mapped at surface. There have been helium releases across that area. And it's also adjacent to a geological anomaly called the Sumatra Thrust, which is a conduit for helium migration. So, amongst this, amongst the project region here, or the Montana asset base, there are multiple targets identified at Ingamo, and these targets include the Amsden Formation, the Charles Flathead, and Precambrian formations. These are overlapping anomalies underground, which the company has devised a drilling campaign which will test all of these targets from a single appraisal well. So that's a very efficient process that's going to sort of ascertain the exact volume and start to really establish some numbers. Currently, there's an estimated P50 unrisked helium reserve of 2.3 billion cubic feet, potential upside of 6.7 billion cubic feet, and it's estimated by the group that it'll cost between $12.5 to $15 million to build a modular processing plant. So that's a fairly modest outlay in the process. So since coming to market, Helix have been busy. The company announced in April a partnership with petroleum consultants based in Montana. They also announced a drilling contract with Treasure State Drilling to provide the Cardwell rig. Now, the Cardwell rig and also the drill manager Will Stenger are significant because Bo Sears has worked with that rig and with Will Stenger twice before. So the Treasure State Cardwell rig will be taken to the Ingomar Dome project, and of course it'll be overseen by Will Stenger, who has a long track record, 30 years in the industry, and of course Bo knows him very well. And all of these connections are key as we build the picture here. So in June this year, the company announced a scoping study, or the results of a scoping study, an NPV8 number of $303 million, and that's based on a conservative estimate of $550 million cubic feet at 1.5% helium. Initial capex estimate of just under $20 million, and expected the Ingomar project is expected to net some $605 million post capex over a 29-year life of mine. So those are pretty exciting numbers. Then, of course, what's really flipped everything on its head and brought a lot of attention to Helix exploration, the company made a second acquisition. It acquired the Rudyard project from a gentleman called Adam Sandiford, who was already consulting to the company. They paid $250,000 both in cash and shares, and also Adam was paid a further 600,000 new ordinary shares as part of his consultancy fee. So this is significant in that helium's already been previously identified there. A domal anticline anomaly with helium has secured a flow of helium to the surface from two wells adjacent to the Rudyard project, which is plugged into the same domal anticline feature. Estimated to be some 484,000 billion cubic feet there. Sorry, 0.48 billion cubic feet, with an in situ value already of $250 million based on, again, that conservative number of $550 per million cubic feet. Now, what David Minchin said when they made the acquisition was it significantly de-risks the Helix portfolio because it's provided the company with a direct pathway to commercial production. He also added it's a testament to Boseer's experience that the acquisition has been made at such a cheap, such a low price, and that's obviously Bo's experience and the opportunity he sees, and of course his experience overall and his position in the industry as a helium expert. Also, from the IPO, remember they raised 7.5 million sterling at the IPO. They are fully funded for 2 wells, and of course they can now drill. We've spoken about the first well at Ingomar, that well that's going to reach all 4 project targets in with one drilling campaign, one hole. The second well is now going to be placed at Rudyard, where the company will use that extended flow testing process to convert those currently contingent resources into reserves. And of course, at that point, you're getting very close to production. Now, this was picked up by a broker called Oak Securities. The note was actually written by Jerry Keane, and Jerry Keane's been around the city for many years. I've met Jerry beforehand, and the company noted that the acquisition was immediately value accretive to Rudyard, and it values Rudyard at $85.5 million with a 76.5 million contingent and an 8.9 million allowance for a deeper exploration play there. So a gross valuation across the project portfolio now of $145 million. That equates to 114 million sterling, and that equates to a share price target of 93p. Now that's with the conservative valuation. Based on an unrisked valuation, that valuation rises to $291 million, and that equates to a 187p share price. Now, the company IPO'd at 10p. It's risen as high currently as 27p on the year, currently trading at just over 20p. So the company at this point, with these assets in place, looks incredibly good value. The Montana asset base as a whole now contains 2C volumes, 525 million cubic feet of helium and 2,176 million cubic feet of natural gas. The company, as I say, has those cash resources preserved. It's looked after and husbanded those resources well since the IPO. So it's fully funded to focus on developing Rudyard, developing that second hole Rudyard, and also, of course, the original Ingomar Dome drilling campaign to target all 4 prospects in one hole. And in summary, the Oak Security said Rudyard provides balance to the exploration portfolio, and once it can reclassifies those contingent resources as reserves and agrees a development plan, then it expects a rapid accretion in value at that point. So I think we're going to see a lot of buyers coming into this, and given the progress the company made already since April, we're just 3 months on since the IPO and the company's already acquired a new project. I think we're going to see a very exciting second half of the year for Helix Resources.
Thank you, Alan. Very comprehensive overview there. And the numbers are looking pretty good, aren't they, on what you talked about there? In terms of their plans, their next sort of immediate plans to move down this development curve, what are we looking at here, do you think?
Well, they have the great thing is they have the cash, as I said just now. They preserve that cash from the IPO, so they can go and drill Ingomar Dome, and they can drill the second hole at Rudyard straight away. My guess is that, and I think we've seen this with a lot of companies, exploration companies, they're looking to generate cash from their assets as quickly as they can. So the near-term win for the company now is Rudyard, and I think they can drill that. Given that 2 wells adjacent to Rudyard are pulling helium to the surface already, this is almost a plug and play solution for them. So I think they're going to be drilling at Rudyard within the coming weeks and months. Perhaps a deal they've made with the Treasure State Drilling will redivert that well to Rudyard instead of Igamar Dome. But I'm sure we'll have an announcement from the company in due course to confirm that. But of course, once that happens, we should know pretty quickly, just what the next steps will be. But at a very exciting junction, nonetheless.
Right. Yeah. Okay. Okay. But heading to sort of early cash flow, I would guess would be the overall theme here, with given the numbers on there from that scoping study.
Yeah, indeed, and I think there's a very real prospect that they could be looking at turning this into positive cash flow. It within a very short or a relatively short period of time. Of course, there are still a lot of hoops to jump through. The hole's got to be drilled, but given what they already know, and of course, Adam Sanderford, who sold the business to them, he knows, he's worked in the area, he's consulting to the company, so he will already have had a plan in place to execute on that drilling campaign. My guess is that he would have done it himself, but of course probably couldn't fund it himself. So he's joined forces with Boseers, and it's a very efficient marriage of resources. And so I'd be very surprised if they're not already on site making preparations, and I'm sure we'll have an update to that end in the very near future.
Excellent. Well, thank you, Alan. So let's now talk about, is it Brave Bison next?
Yeah, Brave Bison. This company's had a hell of a year. It really has. It underwent a transformation. If we look at the share price chart in November last year, we were trading at just 1.5p. Since then, we've seen year highs of just under 3p. Currently trading at 2.65p. So Brave Bison is it's a digital advertising and technology services company. It's got a London headquarters, a workforce in 10 countries around the world, and it provides services via four cornerstone operations. There's number one is Brave Bison Performance, where it plans and buys media on Google, TikTok, and provides SEO services and digital PR to its clients. Then Social Chain, and this is an acquisition the company made about a year and a half ago, and it's been transformative for the company. Social Chain creates content for social media platforms, and it also works with influencers to create content. And we see the impact that influencers have in our day-to-day lives now. Then there's Brave Bison Commerce, which builds e-commerce platforms to support digital commerce operations. Works with clients such as Furniture Village and Fiskars. And then there's the Brave Bison Media Network, which is a portfolio of channels across YouTube, Facebook, Snapchat, TikTok, Instagram, and these channels generate over 1 billion monthly views. So that's highly significant. And the company said in a trading update in April this year that the Social Chain acquisitions has transformed the advertiser proposition. It reported turnover up 13% to 35.7 million, net revenue, gross profit up 23% to 21 million, adjusted EBITDA up 42% to 4.3 million, and adjusted basic earnings per share up 18% to 0.29p. Also, net cash, this company has no debt, up 10% to just under 7 million. So the company said at that point the outlook and current trading for the time, it was ahead of the prior year, and it was confident of meeting expectations in 2024. Then it all kicked off in May. The company made an unsolicited offer for the Mission Group, and Mission Group was carrying some 30 million pounds of debt, and whilst it was generating cash, Brave Bison put together a plan to the Mission Group because it believed Mission's debt was unsustainable, where it could bring the two companies together, utilize the economies of scale that would generate, and also cross-sell their services into existing Mission Group clients and vice versa. So they had a real meeting of the ways and really saw the way forward. But Mission Group refused to engage with them. In fact, one of the major shareholders, DBay, said the offer was very unattractive. They were holding 10.74% at the time. Incidentally, they've now sold down on Mission Group a bit. So, maybe they weren't quite as convinced of that as they first said. At the same time, Michael Ashcroft, a major high net worth, increases shareholding in Brave Bison from 20% to 23.7%. Eventually, Brave Bison walked away from the deal, saying management had refused to engage, and so obviously it would focus on building its own business. As often happens with merger and acquisitions, it's a game of smoke and mirrors, and the company may say it refuses to engage, but perhaps stuff is still going behind the scenes. We don't know. Nonetheless, last week we had an AGM statement from the company. Trading for the first 5 months of the year is in line with previous guidance. Adjusted pre-tax profits expected to be ahead of the prior year, and also it's highlighted another superb performance from Social Chain. And what Social Chain has done for the company, it's converted several low margin legacy contracts. It's replaced those with high value influencer revenue, which has transformed the profitability. So, that's really key. When you've got a low margin legacy contract and you can go in with a company you've acquired and transform that into a high margin contract. That's good. That's smart work in my book. The company's also won a host of new clients during the period, and these include Shark Ninja, don't know what that is, Yours Clothing, the Travel Corporation, Sony Pictures, and also the brewery Green King. So they've had a really strong first half of the year. Will they do a deal with Mission Group? Who knows? Will they make another acquisition? Who knows? But the thing is, their cash war chest is growing all the time. This company has no debt. So I think it offers great value at this current time, and I'm sure we're going to see some more M&A activity before the year's out.
Good. Okay, excellent. Thank you, Alan, for that update. Good to hear. So let's finish off with Manolete Partners then. What are these guys all about?
So Manolete Partners, we have spoken in the past, of course, about various niche companies offering finance to or finance resources to solve particular issues, where cases perhaps need funding, where there are perhaps specific issues. Manolete, AIM-listed Manolete, Epic code MANO, are one such company. They are the UK's leading insolvency litigation financing company, and they fund or they buy insolvency claims and work on a three-way partnership with insolvency practitioners and lawyers, and they've got a very good track record of doing this. They're long established. The team is sort of headed, of course, by Steve Cooklin, who's the chief executive, and he's well known on the circuit, as it were. But again, there are many case studies on the website if you want to sort of go and find out how the company works. If you go to manolete-partners.com, that will tell you all you need to know. So again, another strong trading update from the group back in April. Strong momentum and a return to profit. Now, during COVID, the company saw a real downturn in the business, and of course, if you look at the share price chart, that will sort of show you sort of where the company's come from. But since then, we've seen the company or the shares from the company bottom out prior to that trading update in March. So a low of £1.10 per share in March. Shares have traded as high as 250 pence on the year, as low as 106p. Sorry, no, not 110. And they're currently trading now at 137.5. So building nicely. There's a good share chart, there to look at. And the company has reported a very strong return to profit and real strong momentum in the business. New cases and case completion volumes are running at record highs, and also seeing a greater volume of larger, more profitable cases. And Steve Cooklin said at the time that during 2024, the UK insolvency market fully recovered from the temporary 2-year suppression of insolvencies that Her Majesty's government, of course, enacted during COVID, with all the help it provided through CBILS loans and everything else. Some 311 new cases during that year, up 18% on full year 2023. Second half of the year, Manolete partners signed 20 cases worth over £1 million each. March this year, we completed 28 cases for an aggregate settlement value of 6.6 million. That's just in March. And they currently have 418 cases live. So revenue is expected to be 26.3 million, up from just under 21 million last year. A profit before interest, tax, depreciation, etc., of 2.5 million, and that's up from a loss of 3.1 million last year. Now returned cash, they've got cash of 1.5 million, and that's versus debt previously of 12.25 million. So the company is well on the road to recovery. Not necessarily reflected in the share price yet, is my view. And I think the company has a market cap of 60 million. So just think during March they basically closed cases worth 6.6 million, completed 28 cases for an aggregate settlement value of 6.6 million. If they're doing close to that every year, then I mean, they're generating cash, and there's no real premium in the valuation for the money that they're bringing in. So, I think this is a good solid business, and I'm sure given the area that the company is operating in, we're going to see further progress this year.
Okay, well, thank you, Alan. Something a bit different there, sort of business services, broker services. Do they have any sort of milestones, plans, KPIs for this year where they're going to be focusing efforts?
Steve Coughlin said, they've seen the insolvency market fully recovered from the 2-year suppression of insolvencies that Her Majesty's government enacted. But of course, they've increased their market share, so they are seen as the go-to insolvency practitioner in this area. And of course, it's an area that they have a huge amount of experience in, and we're due some further updates from them shortly. I'm sure they'll be holding their AGM, and we'll have a report from the company very, very soon. But yeah, I think this company is in a good position. It's cash generative, and it now has cash rather than debt that they have the debt that they had beforehand. So that's highly encouraging. And as that cash bar starts to grow, then I'm sure the company will be looking at further opportunities to expand the business.
Alan, thank you again for your time on a Monday.
Thank you, Mark. Good to talk again.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter, and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programmes at stopboxmedia.com. Thank you for watching.